Learning objective 8.3 account for notes payable and accrued interest. A note is a written promise to pay a certain amount of money at a given date in the future with interest. A short-term note payable is a note payable that is due within 1 year. This is often used to finance business operations. So let's assume a company is purchasing inventory on January 1st, 2018, and in exchange, they are signing a short-term note, a promissory note. The amount that's due is $8,000. It is due within 1 year, but there is going to be some interest associated with this, and in this case, it is 10%. So the journal entry on January 1st, which is very convenient, will be a debit to inventory and a credit to notes payable short-term, $8,000 each. So this is on January 1. We're looking at a purchase of $8,000 of inventory. It's going to be a debit to inventory and then a credit to notes payable, which is a liability. It is short-term, so we'll identify it as such. $8,000, that's also $1 So the impact to the accounting equation is that assets are going to increase by $8,000. Liabilities will increase by $8,000 as well. All right, the company's fiscal year ends September 30th. So they took the note on January 1st, but the fiscal year ends September 30th. That means that 9 months after the issuance of a note, they're going to produce a set of financial statements. If the note has not been paid by the time September 30th comes, then during the period between January 1st and September 30th, the company is accruing interest. When I say accruing interest, it means we are obligated to pay for interest during that period of time. At year end, the company must accrue interest expense at 10% for January through September. So the way we compute that is we'll take the $8,000, we'll multiply it by 10%. Well, that's going to give us a full year's worth of interest. But what we're looking for is just 9 out of 12 months. So it'd be 8,000 multiplied by 10% times 9/12. So let's do that. 8,000 times 0.10 times 9 divided by 12. And that means we are accruing $600 of interest expense. So the way that's going to be recorded, it's going to be a debit to interest expense, and it's going to be a credit to interest payable. Both of those are going to be $600. Now to go where this is going to be, this we'll put interest expense. So $600 goes towards interest expense. That is a debit. That's a reduction of equity. And then we're going to create a new account. And by the way, this is as of 9:30, right? And we're going to create a new account called interest payable. Interest payable, just like any other payable, is going to be a liability. So that's going to increase our liabilities by $600. That's consistent with the journal entry. Now, that is where we're at as of September 30th. The company's payment of the short-term note payable at maturity of January 1st, 2019. So on January 1st, now we have to pay off the loan plus any accrued interest. Now in this case, we're going to redo the computation of interest. And now it's not going to be 9/12. It's simply going to be 8,000 times 10%. 8,000 times 0.10, meaning we have $800 that we're going to have to pay in interest. So the check amount, the total amount that's going to be paid is going to be $8,800. Now let's go ahead and see how we're going to record that. So let's take a look at the debits here. We're going to debit note payable short-term for $8,000. We're going to debit interest payable for $600. In both cases, that's removing the payables that are showing on the T accounts. And then we're going to recognize $200 of interest expense. Once you add that all up, that's going to come up with $8,800. That total is the amount that's going to be credited towards cash. Now note, this $600 that was recognized as interest expense as of September 30th went into last fiscal year's financial statements. So when the fiscal year ended, that got closed and we were done with that fiscal year. We're now in the next fiscal year that started October 1st, and we're recognizing another $200 of interest. So the total amount of interest expense for the company is still $800. The difference is $600 of it was recognized in the first year and $200 of it went into the second year. Now we also have what is referred to as the current portion of long-term debt. The bullet point shows, also called current maturity of current installments, the amount of principal that is payable within 1 year or operating cycle, if longer, of a long-term debt. The current portion is considered to be short-term liability, and at year-end, a company reclassifies from long-term debt to current liability the portion of the long-term debt principal payments that must be paid in the next year. So let's assume that you borrow, or we borrow. We're going to borrow $10,000. The rate is 5%. Let's assume it to be 5%. And let's say the term is 5 years. So we'll have to determine what that payment is going to be. The amount of payment is going to be for that. So I can do that using an Excel tool here. We'll call it a function. The function specifically is called PMT, payment, PMT. I'm not teaching you this. I'm just doing it just to come up with the payment here. We're going to look under financial and then look under PMT. So the actual payment is going to be $2,309.75. Every time we make a payment, that's the way it's going to be. So as an example here, let's say in the first, second, third, fourth, fifth year, we have our beginning balance. That's going to be $10,000. When we make a payment, a portion of it is going to be for principal, and a portion is going to be go towards interest. So the way we figure our interest is we'll take the outstanding balance, we'll multiply it by 0.05, take our payment, subtract the interest portion, and then our ending balance is going to be taking the beginning balance minus principal portion. And we can quickly fill these in. So we signed the note on 12/31/20, and now we're ready to accrue for this. And it could be at any time during the year, but let's assume that our payments are due at the end at 12/31. So our first payment is scheduled at 12/31/21. All right, we're putting together a set of financial statements. We know that the total amount is equal to $10,000. That's what we're borrowing. $10,000 is the total amount we're borrowing. So because this is for 5 years, your first inclination to think, okay, this is all long-term. But technically, not all of it is long-term. The portion of the principal that's due within a year is actually considered short-term. Just the principal amount, not the total payment. The total payment that you're going to be making at 12/31/2021 is going to be $2,309. The total payment is $2,309.75. But of that total payment, $1,809.75 is considered to be principal, and that's due within 1 year. So your borrowed amount is $10,000. Due in 1 year is going to be $1,809.75. So then long-term is going to be the difference. So we just have to know that even though the total amount borrowed is $10,000, of the $10,000, 1809 is going to be current, and that's going to go under an account called current portion of long-term debt. And this is going to be long-term payable. So if I want to use those T accounts I used before, so when we borrow the money, let's say we borrowed the money on 12/31, we borrowed 10,000, we're going to debit cash for 10,000, and immediately we're going to just credit long-term note payable. But at 12/31, before we prepare the financial statements, we're going to have to make an adjustment. And that adjustment is going to be a credit of 1809.75 to current portion of long-term debt, and then a debit for the same amount to note payable long-term, 1809.75. So that the balance that's actually going to be reported for note payable long-term is actually $8,190. And the balance that's going to be reported on the financial statements as the current portion of long-term debt is 1809.75.